What if I told you that on a single Monday morning, the global financial system came within inches of collapse, not because of war, not because of terrorism, not because of a natural disaster, but because trust disappeared? 2008. At 1:45 a.m., after a frantic weekend of negotiations, a 158-year-old investment bank filed for bankruptcy. Its name was Lehman Brothers. By sunrise, global markets were unraveling. By lunchtime, billions of dollars had vanished. By the end of the week, the world economy was in free fall. But here's what makes that day unsettling. Most people didn't see it coming. The warning signs were there. The data existed. The risk was measurable. And still, almost no one believed the system itself could break. This wasn't just the failure of a bank. It was the failure of an assumption. The assumption that markets are self-correcting, that risk is contained, that institutions labeled too big to fail don't fail. And when Lehman Brothers collapsed, the illusion collapsed with it. To understand how something this massive could fall so suddenly, we need to examine what everyone believed was impossible. It was supposed to be an ordinary Monday morning in New York City, the sun rising slowly between the glass towers of Manhattan, commuters emerging from subway stations, coffee cups in hand, market screens flickering green and red as traders prepared for the opening bell. On the surface, everything looked normal, but underneath that routine, something was breaking. There was a tension in the air, subtle, restrained, almost unspoken. The kind of tension that doesn't make headlines until it's too late. That morning, a 158-year-old investment bank filed for bankruptcy. Its name was Lehman Brothers, a firm that had survived the American Civil War, the Panic of 1907, the Great Depression, two world wars, the collapse of the dot-com bubble. It had endured nearly every modern financial storm, but it would not survive this one. As news spread, employees exited the Lehman headquarters carrying cardboard boxes. Inside them were small fragments of ordinary life, framed degrees, family photographs, desk awards, personal notebooks filled with years of work. Some faces showed disbelief, others controlled composure, a few quiet tears. What had seemed impossible only days before had just happened. And across Wall Street, a question began to circulate, quietly at first, then urgently. If a giant like Lehman Brothers can fall, who exactly is safe? To understand why this moment mattered, we need to rewind the clock. In the early 2000s, the United States experienced a powerful wave of optimism. Home values rose steadily year after year. Real estate became more than shelter. It became a strategy. Television shows celebrated house flipping. Seminars promised financial independence through property investment. Ordinary families began to see real estate as a guaranteed path to wealth. Banks responded with enthusiasm. Credit standards softened. Loan approvals accelerated. Risk assessments became flexible. Mortgages were issued to borrowers without verified income, without meaningful down payments, sometimes without documented employment. These loans became known as subprime mortgages. On their own, risky loans are dangerous. But what transformed risk into instability was financial engineering. Banks bundled thousands of mortgages together. They sliced them into structured products. They sold them as mortgage-backed securities to investors around the world. Pension funds in Europe, insurance companies in Asia, institutional investors in the United States. And most of these securities carried high credit ratings, AAA, the highest possible grade. as if they were nearly immune to failure. But those ratings relied on a single assumption, that housing prices would not fall nationwide. It had never happened before in modern American history, so models assumed it wouldn't happen at all. And when a system collectively assumes something is impossible, it stops preparing for it. By 2006, housing prices began to level off. Then they began to decline, slowly at first, then more sharply. As adjustable mortgage rates reset, monthly payments increased, defaults rose, foreclosures multiplied, and suddenly those highly rated securities were not as safe as advertised. They were deeply interconnected. Lehman Brothers had positioned itself aggressively in the mortgage market. The firm believed housing would recover. It increased exposure. It increased leverage. It increased risk. By 2007, warning signs were everywhere. Two hedge funds linked to Bear Stearns collapsed. Liquidity tightened. Volatility intensified. Still, many executives believed the downturn was temporary. In March 2008, the Federal Reserve facilitated the rescue of Bear Stearns. That intervention stabilized markets, temporarily, but it also created an expectation. If a major institution falters, it will be rescued. When Lehman's financial position deteriorated over the summer of 2008, executives searched for buyers. Negotiations unfolded behind closed doors. Emergency meetings took place throughout the weekend of September 13th. Potential deals collapsed. Confidence evaporated. And confidence in finance is everything. Late Sunday night, the outcome became unavoidable. Lehman Brothers would file for Chapter 11 bankruptcy, the largest corporate bankruptcy in American history. When markets opened the next morning, investors realized something unsettling. The safety net was not guaranteed, and if one major institution could fall without rescue, others could too. Trust began to fracture, not loudly, but decisively. As trading began that Monday, shock turned into panic. The Dow Jones Industrial Average plunged dramatically. Financial stocks collapsed. Interbank lending froze. Banks questioned each other's solvency. If I extend you credit today, will you still exist tomorrow? Money markets, normally stable and predictable, showed signs of stress. Corporations that relied on short-term financing struggled to fund daily operations. Commercial paper markets seized. The financial system did not explode. It froze. And freezing in a system dependent on constant movement is catastrophic. Within days, the U.S. government announced a $700 billion rescue plan known as TARP. Meanwhile, other institutions wavered. Insurance giant AIG required an emergency bailout. Investment bank Merrill Lynch agreed to a rapid acquisition to avoid collapse. The crisis spread beyond Wall Street. European banks required state support. Global markets declined sharply. Trade slowed. And outside financial centers, the consequences intensified. Unemployment surged. Home foreclosures increased. Retirement savings diminished. For millions of people, the crisis was not abstract. It was personal. In the years that followed, reform efforts reshaped financial regulation. In 2010, lawmakers passed the Dodd-Frank Act, aiming to reduce systemic risk and increase oversight. Capital requirements were strengthened. Transparency improved. Stress tests were introduced. The architecture of finance became more guarded. But the deeper lesson of September 15, 2008, was not purely regulatory. It was psychological. Financial systems depend on belief. Belief in solvency, belief in growth, belief in stability. When belief erodes, numbers follow. Lehman Brothers did not collapse solely because of mortgages. It collapsed because leverage met declining asset values, and confidence vanished at the same time. And every financial cycle carries familiar phrases. This time is different. Innovation has reduced risk. Markets have matured, perhaps, but history suggests caution. Because on that Monday in September 2008, the world was reminded of something fundamental. Complex systems are more fragile than they appear. And when trust disappears, even institutions that seem permanent can fall.